Welcome. Today we're undertaking an in-depth exploration of something pretty groundbreaking in corporate finance,
Yeah,
a real innovation in capital structure.
that's right.
We're looking at a radical shift in how some companies are managing their treasury,
Uh-huh.
moving way beyond, the usual cash, T-bills, short-term bonds, that kind of thing.
Yeah, the traditional playbook.
Exactly. And analyzing a model that really transforms treasury management from just ensuring you have enough cash on hand
A simple liquidity function.
into a fundamental rethinking of the company's capital structure itself, a complete overhaul.
And it's fascinating because this isn't just, say, a different investment choice.
No.
It's driven by a very specific, almost philosophical macro-monetary worldview. It's quite distinct.
Right.
The people behind this strategy, they're deliberately choosing to take on asset volatility specifically, the wild swings you see with certain scarce digital assets.
Mm-hmm.
And they're doing that to get rid of what they see as a guaranteed, almost terminal risk, the risk of holding fiat currency, holding cash.
So liquidity risk, but specifically tied to fiat money.
Precisely. And this really challenges the whole textbook definition of what a corporate balance sheet is for, especially in today's world where, let's face it, the monetary base just keeps expanding.
Perpetually expanding. That's the key phrase.
Okay.
Okay, so that's the core tension we need to unpack today.
Yeah.
Our mission, then, is to really break this down. We need to dissect the underlying macro logic that makes them even consider such a huge shift.
The justification, basically.
Yeah, the justification. Then look at the actual financial mechanics. How do they do this? How do they operationalize this continuous buying strategy?
The nuts and bolts.
The nuts and bolts. And finally, dig into that conceptual framework. Why substitute something relatively stable, like cash, with something known for its volatility? What's the philosophical argument?
And that premise, it's really quite an aggressive critique of standard corporate finance, isn't it?
It really is.
It basically says, holding all that traditional cash when you measure it in real purchasing power is actually harming shareholder value.
Actively harming it.
Yes. And therefore, you need to completely replace that reserve asset with something else entirely.
Okay, start right there with that philosophical foundation.
Mm-hmm.
So this whole strategy, it really rests on one core belief, a conviction that the architects think is almost mathematical.
Mm-hmm.
They argue that the fiat monetary base, dollars, euros, yen, you name it, isn't just expanding temporarily like during a crisis.
Right, not cyclical.
Not cyclical. It's expanding structurally. It's baked into the system, a permanent feature of modern government debt and central bank policy.
That structural expansion is the key assumption. That's the environment they believe we're in permanently.
And if you accept that premise that this expansion is structural, it's mathematically set to continue.
Yeah.
Well, the implication for a company holding dollars or bonds priced in dollars becomes quite stark.
It becomes predictable, yeah. The argument follows that holding cash or those short-term treasuries is actually a guaranteed way to destroy shareholder value over time.
A guarantee of erosion. It's a very strong claim. Can you walk us through the logic there? Why is it a guarantee and not just, a risk?
Well, it really boils down to two things working against you if you're holding dollars. First, there's the explicit rate of monetary inflation, or you could call it debasement.
Cool.
If the total money supply grows by, say, 7% a year, your cash automatically loses 7% of its relative purchasing power. That's just math, regardless of what the CPI says day to day.
Right, separate from consumer prices, it's about the denominator expanding.
Exactly. And second, there's the opportunity cost. Because that cash is guaranteed to decay in real terms, you're automatically missing out on any potential real growth you could have gotten by holding something scarce, something that holds its value.
Oh, okay.
So for a company which has, fiduciary duty to maximize value for its shareholders, this combination, structural decay plus zero chance of real return, it basically turns that liquid cash asset into a functional liability.
Wow. So the traditional safe haven, the balance sheet loaded with cash, seen as the ultimate security blanket.
Yeah, the bedrock of liquidity.
Through this lens, it actually becomes a liability if your goal is preserving real purchasing power over the long haul.
Precisely.
It's saying liquidity is only worth something if the thing providing the liquidity actually holds value itself.
That's it, exactly. If the money itself is structurally losing value, you have to find a counter asset, something with the opposite structural properties.
Okay.
And that's where they bring in the idea of a scarce digital bearer asset, specifically Bitcoin, as the Well, the antidote to this systemic monetary decay.
And the choice of that specific asset, it seems to hinge entirely on its scarcity being provable, right?
Absolutely. We're talking about that hard cap 21 million units, fixed forever.
Mm-hmm.
Plus a completely predictable issuance schedule. The halvings. The scarcity isn't based on promises. It's transparent, it's auditable on the network, and crucially, it can't be changed by anyone.
So they position it like a digital version of gold.
Kind of, yeah. But they'd argue with significant upgrades.
Okay, how so?
Well, it keeps the scarcity aspect of gold, the hardness, but it gains massively because of technology. Think about it. It's globally portable instantly. It's verifiably divisible down to tiny fractions, 8 decimal places.
Satoshis.
Exactly. And it's completely transparent because anyone can audit the ledger. Compare that to gold, you need vaults, guards, complex, slow transfers.
But logistically challenging.
Very. This, they argue, is a reserve asset built for a digital, globalized economy.
Okay, so if we try to fit this into, like, modern portfolio theory,
Yeah.
how does it function beyond just hoping the price goes up? It's serving a specific risk management role.
Oh, definitely. It's meant to function as a convex hedge against that monetary debasement we talked about.
Convex hedge, okay, that's a technical term. What does that mean compared to a normal hedge?
Right, so traditional hedges, maybe like inflation-linked bonds, they usually offer sort of linear protection. Inflation goes up 1%, the bond payout adjusts roughly 1%. It's proportional.
Got it.
A convex hedge, though, offers asymmetric upside.
Okay, break down that asymmetric upside for us. Why is it convex, and what makes its performance, different from the regular economy?
Convexity basically means the potential gains are much, much larger than the potential losses. It creates a non-linear payoff. Think of it like a curve that goes up much faster than it goes down.
Right.
And the reason it has this potential is that the asset's returns aren't primarily tied to things like GDP growth or company profits, the usual economic drivers.
Okay.
Instead, its value is driven by network adoption. Think of the S-curve you see with new technologies taking off.
Like the internet or mobile phones.
Exactly. If adoption goes from, say, 5% of the world to 10%, the network effect can cause the value to compound exponentially, driving the price up non-linearly.
Oh, I see.
And crucially, this means its performance isn't really correlated with the risks in the traditional fiat system it's supposed to be hedging against. That makes it, theoretically, a very powerful structural defense against that debasement.
So the goal isn't just chasing high returns, although that's obviously part of it. It's about achieving long-term preservation through something that grows for different reasons.
Yes.
Reasons outside the system that's decaying. It's a structural defense against the decay of the very money the company uses day to day.
That's the core conviction. They believe that optimizing your WACC, your weighted average cost of capital, or hitting quarterly earnings targets, it all becomes kind of irrelevant if the money you're measuring everything in is fundamentally broken, structurally eroding.
They're trying to escape the melting ruler.
That's a perfect way to put it. They're fighting the decay of the ruler itself.
Okay, so once they have that macro conviction firmly in place, the next step is, well, how do you actually do it? The operational side.
Right.
This is where we see a company, maybe a software firm like MicroStrategy famously did, essentially transform itself.
It's a pivot.
A massive pivot.
Yeah.
It becomes, in effect, a perpetual buying machine for this digital asset.
Yeah, a perpetual acquisition vehicle. It's a complete change in the mandate for how capital is used.
And it's not just a simple decision, is it? It requires some serious engineering of the corporate structure.
Oh, absolutely. This is deep financial engineering. It's not just, oh, let's take our spare cash and buy some.
Right.
It's about designing the entire capital stack, debt, equity, everything specifically to enable and even mandate continuous buying. You're effectively turning the original core business into a kind of sophisticated financing arm for this new digital reserve.
And this buying, this accumulation, it happens through, I think, 3 distinct layers of how they allocate capital, continuously feeding this machine.
That's right. 3 layers. The first one is the most obvious, the starting point.
Okay.
You convert your existing cash reserves. Whatever cash you have sitting on the balance sheet, you swap it for the digital asset. That sets up your initial position, kind of proves the concept internally.
Establishes the base. That's just a one-off, right?
Exactly. That's static.
Right.
The real innovation, the thing that makes it perpetual and allows it to scale massively, comes with layers 2 and 3. Layer 2 involves actively going out and raising new capital, proactively issuing new shares, or more commonly, issuing debt often convertible debt with very low or even zero coupons.
So tapping the capital market specifically to get more fiat money.
Precisely, raising fresh fiat capital.
And then layer 3.
Layer 3 is the immediate, almost instantaneous deployment of those proceeds. The capital they just raised, which, remember, is a liability denominated in that soft fiat money.
The depreciating currency.
Yes. It
Yeah.
gets instantly converted into holdings of the hard digital asset. The corporate treasury basically acts like a high-speed currency exchange conduit.
Wow. Okay. So raise fiat, instantly convert to the asset. Rinse and repeat.
That's the perpetual motion aspect. And this rapid conversion process, it enables what is arguably the most financially sharp part of the whole strategy, what they call the synthetic carry trade.
Okay, let's spend some real time on this synthetic carry trade. Because usually a carry trade is like borrowing Japanese yen because interest rates are super low and investing in, I don't know, Brazilian reals where rates are high. You capture the interest rate difference.
Right, that's the traditional definition.
This is different, though. The yield here isn't an interest rate. It's related to that decay we talked about.
That's the crucial difference, yeah. The arbitrage here isn't based on interest rate spreads between currencies.
Yeah.
It's explicitly based on the different rates of debasement or appreciation between fiat and the digital asset.
Okay, walk me through that.
All right, look at the financing side first. The company issues debt, maybe those convertible notes we mentioned. Their cost of capital might be fixed at a nominal rate, let's say, for argument's sake, an all-in cost of 4% or 5% per year.
Okay, fixed cost.
Critically, that cost is fixed and it's denominated in nominal fiat terms. That's the liability side. A liability in the currency they believe is structurally depreciating.
Got it. The weak money side.
Exactly. Now look at the asset side. They take that borrowed fiat and immediately buy the digital asset. And that asset, based on its history driven by network effects and that inherent scarcity, has compounded in value at annual rates that have, historically at least, just dwarfed that nominal debt coupon.
Okay.
So let's use a hypothetical to make it clear. If they issued debt with a 5% all-in cost of capital, and the digital asset they buy appreciates at an average compounded rate of, say, 40% over the life of that debt.
Which has happened in certain periods.
Which has happened, yes.
Yeah.
The difference, the delta between the 5% cost and the 40% appreciation is 35%.
And that 35% gap is the synthetic carry trade.
That's it. They're borrowing money that they believe is structurally designed to lose purchasing power.
The fiat.
And they're instantly deploying it into an asset they believe is structurally designed for increasing scarcity value. They capture the spread between the nominal cost of their debt and the asset's real appreciation rate.
It's like they're shorting fiat debasement using borrowed money.
That's a very sharp way to put it. And importantly, they're using the existing fiat credit markets, the very system they're critiquing, to fund their exit from that system. They're essentially weaponizing the market's willingness to lend cheaply to a strong company.
Let's dig into that convertible debt structure a bit more, because that seems to be the preferred engine for this trade. Why convertibles rather than just issuing straight bonds or more stock?
Convertibles offer a few key advantages that really fit this kind of high-conviction, high-growth model. First, they usually come with a lower cash interest rate, a lower coupon, than straight debt would.
Okay, so less immediate cash drain.
Exactly. Minimizes the immediate debt servicing cost. Second, there's the conversion feature. The debt holders get the option to convert their debt into company stock in the future if the stock price goes up significantly.
Which it should if the underlying asset performs well.
That's the expectation. So this feature effectively defers some of the cost of capital into the future, potentially paid in equity rather than cash. Third, and this is really important for the company, issuing convertibles lets them get that fiat purchasing power now without immediately diluting existing shareholders through a big stock offering, provided the asset performs as expected.
But there's still a dilution risk down the line, right? If the asset moons, the stock price follows, and those debt holders will convert, creating new shares.
Absolutely, that risk is there. But they manage it through the conversion premium. When they issue the debt, the price at which it can be converted into stock is set significantly higher than the current stock price, maybe 40%, 50%, even higher.
Creating a buffer.
A substantial buffer, yeah. So if the conversion is eventually triggered, it means the underlying asset has already performed exceptionally well, the company's value has soared, and that increase in value should, in theory, more than offset the dilution from the new shares being created.
It's a calculated trade-off then. Accept potential future dilution in exchange for getting immediate leveraged exposure to potentially exponential growth right now.
That's the calculus. And it means the long-term success of this entire strategy really hangs on maintaining that positive differential. The asset's network effect, its value compounding, must consistently outpace the nominal cost of the debt used to buy it.
If that gap flips negative for too long.
The model comes under serious pressure. It could break.
Okay, so moving from the financial plumbing to what this actually does to the company's structure.
Yeah.
This whole operational model, it fundamentally changes what the company's stock represents to investors, doesn't it?
Oh, profoundly. The entire setup effectively creates leveraged exposure to the digital asset, but it's all neatly packaged inside a single publicly traded stock.
And that packaging is key, especially for big players, right?
Yeah.
Institutional investors.
Incredibly significant, yes. For them, the company's common stock basically becomes a high beta derivative of the underlying digital asset.
High beta meaning it moves more percentage-wise
Well,
than the asset itself.
generally, yes, because of the leverage involved. And this offers regulated entities, think pension funds, endowments, large asset managers, a relatively easy way to get exposure.
Easier than buying the asset directly.
Much easier. They don't have to deal with the complexities or often the institutional restrictions around direct custody, securing private keys, navigating the specific regulations for holding the asset directly on their balance sheets.
So investors are essentially buying a kind of structured product. It combines the asset potential upside and volatility with the relative familiarity and regulatory ease of a publicly listed company.
That's a good summary. And the leverage comes from using both debt and potentially equity issuance to keep piling into the asset holdings.
Which amplifies both gains and losses.
Exactly. And that inherent leverage is why the structural stability provided by the company's original business, what you could call the dual engine design, becomes absolutely critical.
Dual engine design. Explain that. How does it act as a safety mechanism?
Okay, so engine number one is the core operating business. In MicroStrategy's case, the software business. This part needs to generate steady, predictable, hopefully low volatility cash flow.
The traditional part of the company.
Yes. And that cash flow stream is strategically ring-fenced, you could say. It's primarily dedicated to one thing: servicing the interest payments on all that debt they've issued.
Paying the coupons.
Paying the coupons. This ensures that, ideally, no matter how much the price of the digital asset swings around in the short term, the company can meet its obligations and avoid defaulting on its debt.
So the operational engine keeps the financial structure solvent.
That's the plan. Then, engine number two is the digital reserve itself. That's where the long-term growth potential lies, the hedge against fiat decay, the core strategic bet. But the forced engine pays the bills to keep the second engine running.
This brings us right to their whole philosophy on risk, because they are explicitly embracing massive volatility. How do they draw the line between volatility, which they accept, and decay, which they reject?
They draw a very bright, very fundamental line between the two. Volatility, in their view, is endurable.
Endurable, meaning
Meaning an asset might crash, say, 70% or even more. But because the underlying properties of the network, the scarcity, remain intact, it has the potential to recover and eventually reach new highs, maybe over several years. Volatility is seen as just the unavoidable price you pay for true scarcity in a new asset class.
cost of admission, maybe.
Kind of, yeah.
Noise along the path.
Okay, and decay, fiat decay.
Fiat decay, on the other hand, is viewed as terminal.
Terminal, like fatal.
Essentially, yes, because it's the guaranteed structural erosion of purchasing power from which there's no recovery. Why? Because the central authority can always print more, diluting it further. There's no mechanism for it to regain its lost value structurally.
Got it.
So the strategic choice becomes, do you accept the bumpy, volatile path that potentially leads to purchasing power preservation over the long run? Or do you accept the smooth, predictable, but guaranteed path towards purchasing power loss inherent in holding fiat? And they choose volatility over decay,
Explicitly.
which naturally forces their time horizon way out towards decades, not quarters.
That highly leveraged structure, even with the dual engine, it must introduce a huge risk around liquidity, especially managing the debt.
Yeah.
If the asset price crashes and stays down for a long time,
Right.
that could seriously jeopardize the collateral value covering the debt, couldn't it?
That is the absolute critical risk.
Right.
A deep, prolonged drawdown would severely impair the value of their asset holdings relative to the fixed nominal amount of debt they owe.
Yeah.
It's the nightmare scenario.
So what specific disciplines do they have to employ to manage that leverage risk? It must be intense.
It requires extremely stringent financial planning and discipline. First, structuring the debt maturities. They aim to ladder them over many years.
Laddered maturities, meaning?
Meaning instead of having one huge $2 billion bond payment due in year 5, you might have smaller chunks, maybe $400 million due in year 3, another $400 million in year 5, another in year 7, and so on.
Oh, okay. Spreading it out. Exactly. This avoids the cliff edge scenario where a massive repayment obligation hits right in the middle of a market crash. If the maturities are staggered, they have more flexibility to manage or refinance smaller pieces as they come due.
Makes sense. What about managing the collateral itself day to day? Do they need to keep cash on hand just in case?
Absolutely essential.
Oh.
They have to maintain significant fiat liquidity buffers, good old-fashioned cash, and maybe some short-term, highly liquid assets.
The very thing they're trying to get away from, ironically.
Well, yes, but held strategically for a specific purpose, to weather those inevitable downturns and meet the periodic interest payments without being forced to sell their core digital asset holdings at fire sale prices.
So rule number 1 is never be a forced seller of the main asset.
That's the discipline. Furthermore, if they take out loans secured against their digital assets, they need to carefully manage the loan-to-value, or LTV, ratio.
Right.
While the specifics might vary, keeping that LTV comfortably low, say, well below 50% or 60% during normal times, gives them a crucial buffer if the asset price drops significantly. It prevents margin calls.
Wow. So it's a real tightrope walk. You're intentionally leveraging up on a super volatile asset to capture maximum potential upside, while simultaneously needing to keep enough traditional safety nets, cash buffers, careful debt staggering, just to survive the extreme volatility you claim you're embracing.
It's a very sophisticated, very high-stakes balancing act. You could see it as the practical application of their core philosophy. They'll use just enough of the old monetary system, the fiat credit and cash buffers, to facilitate their long-term escape from the gravitational pull of that very system.
Okay, we need to shift gears a bit now, step back from the pure finance, and look at the underlying philosophy. What's the deeper belief system driving this conviction?
Right.
Because the model goes way beyond just calling this asset a store of value or maybe a new currency. The main proponents, particularly Michael Saylor, they reframe it conceptually. They talk about it as digital property, or even more fundamentally, as digital energy.
That analogy to energy is really crucial, I think, especially when they're trying to explain the long-term vision to people grounded in traditional finance or even physics.
How does that analogy work?
Well, think about physical energy that's been captured, like electricity stored in a battery or fuel in a tank.
Okay.
That captured energy, it can be stored over time, it can be transmitted across huge distances, or it can be converted into different forms of work, right? And ideally, without losing the fundamental energy content due to decay or degradation.
Right, energy conservation.
Exactly. This framework argues that the digital asset, specifically Bitcoin, does the exact same thing for economic energy.
Economic energy, meaning human work.
Productivity. Precisely. It's viewed as a technology that takes human productivity, the output of our physical and intellectual labor, our capital investment, and converts it into a form that is secured by cryptography and can be transported anywhere instantly.
Okay. And the key difference being?
The key difference is that this stored economic energy, this stored work, cannot be diluted by any central authority or third party. It aims to be a perfect monetary battery, storing the value of human effort and capital across time and space far more efficiently than traditional methods.
And this isn't just a metaphor, is it? They try to anchor this concept in the physical world somehow.
They do, yeah, through thermodynamics and the proof-of-work consensus mechanism that secures the Bitcoin network.
Proof of work. Explain that link.
So proof-of-work fundamentally enforces a kind of conservation of economic energy. To create a new unit of the asset, to mine a new Bitcoin, you have to expend real-world physical resources, primarily electrical energy powering specialized computers that perform complex calculations.
Right, the mining process consumes vast amounts of energy.
It does. And that linkage, that requirement to expend measurable physical energy and capital costs to create a new unit, is what gives the asset what they call its unforgeable costliness.
Unforgeable costliness. That sounds like the economic moat they talk about. Can you contrast that with how fiat money is created?
It's a stark contrast. Think of it as the difference between something naturally scarce and difficult to produce, like digging gold out of the ground, versus something manufactured that has basically zero marginal cost of production.
Like printing paper money or adding zeros in a digital ledger.
Exactly. Fiat systems are ultimately backed by government decree, by faith and regulation, but the actual act of creating more fiat requires virtually zero physical effort or real resource expenditure. A central bank can conjure trillions with a few keystrokes.
And that zero marginal cost of production.
Leads inevitably, they argue, to the temptation and eventual reality of dilution and structural decay over time.
Whereas the digital assets creation is directly tethered, to spending real thermodynamic energy. Its supply increase is constrained by real-world physics and costs.
Precisely. That direct link to energy input provides an intrinsic, unforgeable production cost. It makes it impossible, they contend, for any fiat system to replicate its scarcity or its long-term monetary integrity.
So when you look at it through that lens, the volatility starts to look different.
Perhaps. Instead of seeing volatility as just random noise or pure speculation, you might start to see it as the dynamic price discovery mechanism needed to constantly reflect that underlying scarcity and the real-world energy cost embedded in the asset.
It reframes the whole thing. It allows them to justify the strategy based on what they see as immutable physical principles, not just temporary economic trends or market sentiment.
Right. They're substituting a monetary system based on promises, which can be broken, with one based on physics and mathematics, which they believe are unbreakable. A thermodynamically sound, self-verifying foundation.
And that philosophical conviction, that deep belief, is what ultimately gives them the nerve, frankly, to issue billions in debt against an asset that swings so wildly in price.
They genuinely believe they're holding a fundamentally superior form of property, secured by math and energy, not by political promises.
So we've kind of touched on this, but let's make it explicit. The time horizon for this whole strategy isn't about hitting next quarter's numbers. It's fundamentally decadal, isn't it?
Absolutely. Minimum decadal. The Treasury isn't being managed like a typical corporate liquidity pool ready to be dipped into for operational needs. It's being modeled more like a perpetual endowment.
A perpetual endowment, like a university's endowment fund, meant to last forever.
Exactly that mindset. And that dictates their tolerance for risk, particularly short-term price swings.
Right.
By modeling the Treasury as having no terminal liquidity need.
Meaning they never plan to sell the core holding to pay bills or dividends.
That's the ideal, yes.
Yeah.
By adopting that stance, they effectively remove the pressure to liquidate assets during market downturns, during those scary drawdowns. This allows them to just absorb the mark-to-market paper losses, ride out the volatility, and stay focused entirely on the ultra-long-term goal, preserving and hopefully growing purchasing power over 10, 20, maybe even 50 years.
And this commitment to the long haul, combined with the leverage structure we discussed, it creates a really interesting effect on the company's stock valuation, right? It gives the stock a kind of powerful call option effect.
That's a great way to describe the dynamic on the balance sheet, yeah. Let's quickly revisit the structure. The company's liabilities, all that convertible debt, are nominal. They're fixed obligations in fiat currency terms.
Fixed number of dollars they owe.
Right. But the assets they hold the digital reserve are potentially repricing in real non-dilutable terms driven by that network adoption S-curve we talked about.
So liabilities are fixed and potentially decaying in real value, while assets have potential for exponential real growth.
Exactly. So if global adoption continues, if the network effect deepens and the asset's price scales significantly, maybe exponentially, the company's equity value, the gap between assets and liabilities, should also scale exponentially, potentially far faster than the underlying asset price itself because of the leverage.
It reminds me of the sensitivity you see with, say, leveraged gold mining stocks.
It's a very similar dynamic.
If the price of gold goes up 10%, a highly leveraged miner stock might jump 25% or 30% because their costs are relatively fixed, but their revenue isn't.
Precisely. In this case, the company's stock acts like a leveraged play on the price of the digital asset. But, and this is a key distinction, proponents make it does so without the operational risks that come with mining. You know, no geological risk, no labor issues, no environmental permits.
Right, the leverage is purely financial and structural, not operational.
Exactly. It simplifies the mechanism dramatically. And when you pull all these threads together, the macro view, the operational mechanics, the long-term horizon, and look at it from a sophisticated institutional finance perspective, you arrive at this concept of intertemporal arbitrage.
Intertemporal arbitrage.
Yeah.
Okay, arbitrage usually means exploiting a price difference simultaneously in different markets. Intertemporal means across time. So what's the inefficiency across time that's being exploited here?
The perceived inefficiency is the traditional capital markets' current, potentially temporary misunderstanding or mispricing of this scarce digital asset relative to fiat currency.
Okay.
The strategy uses conventional, regulated, well-understood capital market tools like those low-coupon convertible bonds to gain highly leveraged exposure to what they see as a completely non-correlated hard cap asset class with unique long-term properties.
So they're using today's relatively cheap borrowing costs in the fiat system
Yes.
to accumulate large amounts of an asset they believe will be vastly more valuable in the future.
That's the core arbitrage. Borrow aggressively today in what they believe is weak money, the structurally inflationary fiat currency, to continuously accumulate what they believe is strong money, the scarce digital thermodynamically backed asset. They are literally arbitraging the perceived difference between the guaranteed expansion of the fiat credit supply and the guaranteed scarcity of the digital asset across time.
The real genius of the structure, perhaps, isn't just the raw leverage, but the wrapper. It's synthesizing this high-risk leverage play with what they see as a fundamental risk-off monetary hedge.
Exactly.
All bundled together in one vehicle that's audited, regulated, and publicly traded.
It makes it accessible and somewhat understandable, even if radical. And this whole approach, it points towards their ultimate ambition, their end game, which is to effectively establish a new standard for corporate finance, perhaps eventually a Bitcoin standard at the corporate treasury level. The goal is to set such a compelling precedent that other corporate treasuries, university endowments, maybe even sovereign wealth funds, eventually acknowledge the structural problems with fiat and start adopting this digital asset as their primary reserve asset.
Wow. So analogous to how gold used to be the foundational reserve for national treasuries before Bretton Woods fell apart.
That's the analogy they draw, yes. This company, by this logic, is positioning itself as the publicly traded, audited, regulated prototype. It's demonstrating out in the open how a major corporation can fundamentally integrate this new type of asset deep into its capital structure, arguably while still fulfilling its long-term fiduciary duty to shareholders.
If this model actually works over, say, the next 10 or 20 years,
If it's validated, yes.
it could fundamentally redefine how corporate finance even thinks about the cost of capital, couldn't it? Maybe that cost eventually gets anchored to something deflationary or stable rather than something perpetually inflating.
That would be a seismic shift. It could change corporate behavior globally, influencing decisions around investment, M&A, dividends, everything.
It's really a complete reconfiguration of the relationship between a company's treasury and the broader macroeconomic monetary policy environment itself. Hashtag outro. So what we've really examined today is a remarkably sophisticated structural innovation in finance. This corporate model, it represents a very deliberate, very bold attempt to, as its architects might say, extract the company balance sheet from the gravity well of inflationary fiat.
Good phrase.
Using this hard cap digital asset as what they see as a thermodynamically sound, self-verifying monetary foundation, really designed for perpetual preservation of purchasing power.
It is crucial, though, for everyone listening to remember that the success of this highly leveraged, extremely high conviction strategy isn't guaranteed. It really depends on two critical external factors panning out.
Okay, what are they?
First, the underlying asset itself must continue to see its network effect grow, and its price appreciation, on average over the long term, must continue to significantly outpace the rate of fiat currency debasement. That positive differential we talked about has to hold.
The core bet has to be right, basically.
The core bet has to be right, long term. And second,
the traditional capital markets need to continue to provide the fuel for this perpetual acquisition engine.
the funding.
Yes. Markets need to remain willing to underwrite the company's convertible notes, its other debt offerings, at reasonably affordable costs. Cheap capital, or at least accessible capital, is the essential lubricant for this entire machine. If that dries up, the perpetual motion stops.
So those are the key dependencies. But regardless of the ultimate outcome, this model has provided the financial world with a very transparent, heavily audited, and fully regulated prototype. It shows exactly how a public company can operate under this pretty unique capital structure.
Right. So maybe we leave you, the listener, with this final, perhaps challenging thought to consider for yourself. If this prototype is validated over the next decade or so, if it definitively proves that swapping short-term volatility for avoiding long-term currency decay actually preserves superior real value for shareholders, how drastically could this precedent redefine the fiduciary duty of CEOs and CFOs everywhere when it comes to managing cash?
That's the big question.
Could holding billions in traditional cash reserves eventually be seen not as prudent, but as a dereliction of duty in the face of what proponents call guaranteed structural monetary expansion?
It's a really powerful question, and certainly something worth watching closely as other large corporations inevitably start evaluating this very bold strategy.
Indeed. Well, thank you for joining us for this extensive examination of corporate capital structure innovation.
Thank you.
We'll catch you next time.